It is my honor today to introduce our opening keynote speaker for the Reinsurance Symposium. He is among the select few experts who have built reinsurance into a true profit center for agents as well as for dealers. So without further ado, please welcome my friend, Jim Smith.
First off, I want to thank F&I Magazine, and I want to thank David Gusaldo, and I want to thank Tariq for inviting me to be here. And David just reminded me of something. I have spoken once before at this, and it was the first one, but we shared the location with the adult video convention next door. So I have to say that F&I Agent Seminars come a long way since then, and to see this, I am really impressed with them, and I know that Ed Bobbitt, if he was here today, would really be proud of what they have done to carry on the tradition of F&I Agent Seminar. And I want you to know I made a promise to them. I'm going to try to give y'all as good of information and as unbiased of information as I can, so you come away from this meeting at least being able to carry on a conversation with your dealers and maybe with other direct writers and administrators. As you know, I'm the CEO of SouthwestRe. I'm also the chairman of the board of Dealers Insurance Company, and so I've got a pretty good knowledge of what y'all have to deal with when you're dealing with direct writers. And what I hope to do is give you some straight Scooby as far as what the direct writers, what the administrators are looking at on one side, and then what the dealers and other potential clients are looking at on the other side when you're talking to them. But a little primer to start with. Captive insurance is the genesis of the producer-owned reinsurance companies. And captive insurance is literally where an insurance company that pays for insurance for itself, they sometimes form their own captive insurance company, and then they put the premiums in that. This started in about the late 1800s, but it really had its first company in 1935, and I'm going to be challenging some people in here a little bit as far as that's concerned. But captive is when a parent company pays premiums to its subsidiary. Our industry is not that. Our industry is where a producer actually pays premiums to a insurance company. The IRS coined a term, but the term they coined was not really accurate. It's PORC, Producer-Owned Reinsurance Company. And it's not a producer-owned reinsurance company. It's a dealership that owns it's a dealer that owns a dealership, and the dealership is a sibling or a brother-sister relationship with the insurance company. And this is important because if you have the parent here, the brother here, and the sister here, the IRS lost a tax court case in the late 80s that said a brother-sister relationship, the premiums are deductible. And from that point forward, reinsurance has been a thing that's completely legitimate, that as everybody in here hopefully testifies to, has grown and grown in this industry. But however, there's been a lot of terms coined over the time, and I did a little graph here. With apologies to Noah as in ark, Central Park as in park, and Little Piggy as in pork, I'm going to refer to the name where the profit-sharing concept truly came from, and that is captive. For today, since we're not really talking about captive, we're talking about porks, as the IRS calls them. I'm just going to refer to them as RICs, or reinsurance companies. And RIC, what I'm going to be talking about, it refers to every structure that you can envision exists today. So I'm not saying one is better than another. I'm just calling them all RICs, even if they might not be a reinsurance company, even if they're a direct writer. There's still a structure that the dealer and or the agent can participate in the profits. We decided we're going to give out a door prize, try to have a little fun in here. I found this out about 1.5 years to 2 years ago, and I was reading about the history of captive insurance. And the first truly recognized captive insurance company was formed in 1935. And what I want to do is whoever picks it right, and if your name is drawn out of the bowl, we're going to do a two-person, all-expense paid trip to the Turks and Caicos Islands. And if everybody knows me, they know that that's where we hold a lot of meetings over there. And I bet there's several people in this room that have been over there with us. And it is really one of the nicest places going. So, and this is as esoteric as it can be. And the only way that you'll know this if you really know some trivia along the way. But if somebody can get that, we will give you the 2 tickets to the thing. So what I'd like you to do, if you know the answer, put it on a business card, and then we're going to put the correct answers in the bowl and pick it out. So if anybody knows, and this is the original name of the first captive insurance company formed in 1935, and just for a little teaser, it was formed in Youngstown, Ohio, just in case you'd like a little more help. Now I'll get into what you're here for. First off, though, why reinsurance? I mean, why would you want to consider reinsurance over some other type of program that you could give to your dealer or yourself or whatever? Commissions, whatever. I got 4 reasons. First one's safety. Second one's the most profits. Third's access to funds. And fourth is the future. Now, safety, this is firsthand experience to me. I was in business for 3 years. We were writing credit insurance. And we're writing through a company in the Northwest, and I got a phone call, and somebody told me that they just saw a disturbing ad in the paper today, and not ad, front page headlines. And the headline said that a company called First Far West had just been taken over by the state. Well, I said, that's okay, because we write through Far West America, and they're an A-rated company, so there's no problem. Well, little did I know that was a subsidiary. I did know it, but being the subsidiary, the state took over both companies. And we've been writing for about 1.5 years, and we had about $13 million of credit insurance in trust, but they're all in reinsurance companies. And the state, well, the reason the company went under is they had underwritten the health insurance for the California State Teachers Union. And 1.5 years into a 3-year contract, they were out of money. And the state was trying to get every penny they had. We had $13 million in reinsurance companies. And I'm happy to say the state didn't get a penny of it, and we were able to transfer that money. The second one is reliance. I'll bet you there's a lot of people in here that wrote with Alliance. And I bet very few of you did reinsurance. You probably did it on a direct basis. Reliance went under, and I don't need to ask you what happened to the money. They went under because of poor investments and because of catastrophic coverage. Hurricanes, things like that. And as soon as they hit, the money went away. And the last is Western Insurance Company. And Western did direct business. You probably have heard of that. And they also did reinsurance business. The direct business all went away. The reinsured business all got transferred to another company, and they were made whole. So as far as safety is concerned, it's my contention that reinsurance is absolutely the safest way to go as far as protecting you and your clients. The next one is fairly easy. A reinsurance company, it pays very little tax inside the company if you qualify correctly, and when you take it out, you get capital gains. If you got ordinary income, and the capital gains rate's 20% plus a little bit. If you've got ordinary income, you're talking about 40%. So reinsurance company starts with a 20% profit or 20% advantage the first day you're doing business. So that's my second argument. Oh, I forgot. I'm going with a equine theme today. If y'all watch the Kentucky Derby, you know that who won the Kentucky Derby, and it's pretty funny about there's some 6 degrees of separation, some Kentucky Derby correlation of the presentation this morning. Reason number 3, I decided I'd spice this up a little bit. There's been some advertisements in F&I magazine, and you've also seen some editorial type stuff that, it's, can you borrow money? Can you not borrow money? Is it dangerous? Is it safe? Well, we've been letting dealers borrow money for 31 years. And this is a knock on wood statement. So far, no dealers have ever lost money from a loan default if they borrowed money out. So I'm saying it's not a bad thing if a dealer borrows money, but if they do borrow money, your direct writer is going to make sure that they file the policy correctly. They're going to make sure that the business is profitable. If you loan money with unprofitable business, that's not very smart. And you make sure that the product is the proper product. There's some products out there that you just cannot ever loan any money out of reserves. The money has to stay in reserve from the first day to the last day. But there are products out there where there's alternative reserving methods. I'm not going to tell any secrets today, where you can legitimately loan money out of your reinsurance company before it's earned completely. And the fourth reason why reinsurance over anything else is just, I think it gives you the best way to protect against the future. If you own the business, it's your business or it's your client's business. And basically, they can't take it away from you. I told you about the safety the safety issues. It's just really, you're protecting yourself and your client to the best extent if it's in a reinsurance company, both now and in the future. So those are 4 reasons why I say that reinsurance is the way to go. So if you decide that you do want to do reinsurance, then which way do you go? I've got some reinsurance terms here, and then I got some regulatory issues that have happened over the years, and then one of them has just happened fairly recently. Types of reinsurance. In the last week to 2 weeks, I've heard the term unauthorized used a couple of times, and somebody just had a scowl on their face. There's 2 types of reinsurance. One's authorized and one's unauthorized. Unauthorized is not a bad word. If all y'all do reinsurance, I can almost guarantee that every one of you does unauthorized reinsurance, and you do it with everybody acknowledging that. And all that means is that the company that's reinsuring the business is not authorized to write the business. I mean, in the casualty insurance industry, you often see a billion-dollar company that has an opportunity to write some business, but they're not licensed in a given state. They negotiate with a company that is licensed, and they reinsure it into them. And even though they've got $1 billion and they've got $1 billion, you still have to set up a trust account. So when a direct writer asks you to set up a trust account, it's not because they don't trust you. It's not because of any negative reason other than the only way they can reinsure the business into your reinsurance company is if you set up a trust account. And they have to have direct writer control over the business. No ifs, ands, or buts. So that's something that you just have to tolerate in this business. But once that does happen, it belongs to the reinsurance company, even though the signatory authority is with the direct writer. But if you have a good reinsurance agreement and it is legitimate and it's favorable to both parties, let's say, you should be able to get all the profits on the business, and there shouldn't be any issue there. So trust funds are not a bad thing, and funds held is not a bad thing either. But it's a way for the direct writer to legitimize or to take credit for the reinsurance that's ceded. And ceded means it goes from the direct writer to another company that's ceded into your reinsurance company. The other thing I talk about a lot, and that's first dollar business versus XOL business. People ask, is first dollar sounds like it's a lot safer than XOL. At the end of the day, both of them are literally have the same safety factors. If you write $1 million worth of premium, let's say 1,000 policies at $1,000 a policy, that's $1 million. It's going to go into a trust account, whether it's first dollar or XOL. So it's going to stay in there. If it's XOL, which stands for excess of loss, there's more flexibility. And if somebody recommends doing XOL, you might want to consider that. If somebody says they only do first dollar, then you just say, fine and dandy, let's go forward. But you literally have the same amount of safeguards one way versus the other. And then there's reserving methods. The 1,000 times 1,000, that's $1 million. So you got $1 million in the bank. Day one, you've got $1 million worth of reserves. But how much do you need to pay claims? If you've got a good dealer client, hopefully you're only going to need $500,000 to pay claims. You can literally structure it where you can set up reserves based upon the claim reserve. And I'm not saying it's easy to do. I'm not saying that you should do it. I'm just saying it is possible to do it. And then everybody sees the way fees are quoted. I don't have a problem with y'all making money. If you want to put agent commission, or if you want to put anything you want that you can think of into the reinsurance fees or the ceding fees, then work with your direct writer, work with your administrator to do that. But I think transparency, or as Southwest Airlines says, transparency. Damn, I hope I don't get sued for that. But transparency is good. And basically, and I'd help support anybody, or I bet any of your direct writers or anybody would help support y'all as far as the way that you quote the fees. Now, this is my first editorial slide, and not editorial, it could be editorial. There's been a lot of things that's happened over the 30 years that I've been in this business. I was going to talk about the three long-standing things, but I think I'm going to shorten talking about them a little bit, even though I am going to mention it. Everybody wants to know about the new tax code, and the acronym is PATH, Protecting Americans from Tax Hikes. That's almost as good as the one they did 10 years ago. But basically, a lot of people are trying to read something negative into that, and I really haven't read anything negative into it. Basically, what it did is it took the former 831b2, and that's the tax code for small casualty insurance companies. If you're under $1 million to a premium, you can elect to be taxed only on investment income. So what it did is it changed the premium benchmark for 831b2, and what it changed it to is 2.2 million. Now, it doesn't start this year. It starts at the end of next year, or 1/1/17 is when it starts. So if you've got somebody that's going up to 1.4 this year, you got a problem. But if they go up to 1.4 next year, you're okay. The other language is, I still don't understand it, but I have talked to some experts out there that they say they do understand it. And what it's really targeting is people that are using reinsurance companies for estate planning, for avoiding taxes for estate taxes, transferring from one generation to another generation by distributing the ownership. And that really doesn't apply in what we're doing. So I don't see that having any great impact on what you're out there marketing today. The second one, and this is not new, but it's still as important today as it was then, and that's TAM 9601001. And what that is, TAM stands for Technical Advice Memorandum. What it does, it allows a non-insurance company or an obligor company to file its tax return as an insurance company. And that literally is the premise behind a dealer-owned warranty company right now. And as far as me and my personal knowledge of that, we've been using that TAM since 1996, or let's say 1997. So we've got almost 20 years of experience in it, and it is functional and it does work. Now, there are some potential abuses, and you have to watch out for that. I'm going to go into that a little bit, but basically TAM 9601 does work. And y'all will all get a copy of this when it's over with, and you can see TAM 9601, and you read it, and you're going to be as smart as anybody else out there. And the third thing is the Panama Papers. Everybody's been reading, hopefully, well, not hopefully, I bet everybody couldn't avoid reading about the Panama Papers, but that has to change the regulatory environment out there. I mean, here is Panama is forming offshore, if you will, companies, not insurance companies, just companies, and they're done strictly for tax avoidance in the states that they are, in the countries that they're in. So you're seeing what might be even a knee-jerk reaction right now in various parts of the world. And part of it is coming down to affect us a little bit. There's also the IRS Dirty Dozen. And I am going to the two things. The Panama Papers is the fourth thing I was going to talk about, not one of the first three. But the IRS Dirty Dozen is a list, the broad list of things that the IRS looks at as abuses in this industry. I mean, not this industry, in the world with taxpayers. There's two that could potentially apply to this industry. And one is abusive tax shelters. Abusive offshore. No, let me start over again. It's offshore tax shelters. And we're not talking about insurance tax shelters. We're just talking about offshore companies being formed to avoid taxes. The IRS is looking at that. Fortunately, we just talked about the 831b2. Most of the porks or the RICs that are formed are not formed to avoid taxes. They're formed to allow the dealer to make more profits, even though there can be some abuses. And so that's what you just have to be cognizant of. The other one is pretty funny. I told you this was going to be an equine theme today. Did everybody watch the Kentucky Derby? Anyway, I'm going to get the name wrong again. Who won it? Who was it now? Nyquil. See, I keep wanting to say NyQuil. I didn't want to embarrass myself. It's Nyquist. But I Googled the owner of Nyquist. I'm just wondering why some guy that looks like this is worth $1 billion or whatever got the horse. And anyway, when you Google something, you're going to get something good or you get something bad. It turns out he had sold his company about 4 years ago, and there's one unnamed Big Four accounting firm that had recommended a tax shelter to him, and he did a fairly complicated strategy, and he avoided all the capital gains on the sale. And I guess about 6 months ago, he just lost the tax court appeal, and he's got to pay the taxes. So the owner of NyQuil he tried to do one of these abusive tax shelters, and he got caught. So that's the two things in the dirty dozen that potentially could be what we are. I'm going to leave it at that right now, but I may digress a little in just a minute to get back there. I want to talk about structures, and basically I think that's what you're here for, and you'd like to know which is the best. If you're going to recommend something to your client, or if you want to do something, which is the one you want to recommend? These are the structures that we're talking about. Domestic, controlled foreign corporation, non-controlled foreign corporation, dealer-owned warranty company, or other. And we're all aware of there's other types of mechanisms out there, and I'm going to try to put them in the most applicable here as far as comparison purposes. So which is best? I spent about a day and a half, and if you can't see this, it's okay. I'm going to tell you the numbers on it. Doing this relative comparison. And I really tried to I took what David and Tariq asked me. They wanted me to give you the most unbiased and advice I could give you. And I was trying to come up with things that people look at when they're determining a reinsurance program. I had 5 objective considerations: annual cost, effective tax rate, size limitations, potential tax benefits, and financial benefits. I call those the objective ones. And then I did 5 subjective ones: regulatory acceptance, IRS acceptance, I can't even read it, flexibility, corporate control, and asset control. I did those 5, and then I did I just did a scale, 1 to 10, 1 being good, 10 being the worst. And I assigned a factor based upon what I perceived was, obviously you know what the cost is for doing business. You know what the control of the assets are. You know the objective things. But I'm just using my knowledge of this business, what I know is being audited, not being audited, what the states are looking at, what the states are not looking at, as far as the as far as the subjective considerations. And I added them all together. And then I came up with a number, but even that I started asking myself, what if it's a dealer that wants to be as aggressive as he could ever be? Or what if it's a dealer that wants to be as conservative as he could ever be? And I realized I needed to do a little bit more. So down at the bottom, I put the factors down that were most applicable to whatever we were evaluating. The first is just cost. If cost is a factor, and I've talked across the board the cost. The second one, if control is a factor. Usually got somebody, they'll pay more if they just get more control. Third is risk averse. Somebody, they don't want to ever have any problem with Uncle Sam, just don't talk to me about it. The next one, if they're risk aggressive. I just want to be as aggressive as I can with whatever you do. And the last one, if producer size is a factor. If you've got a huge dealer group out there or just a huge anything. Anyway, here's what happened. I've got five comparisons there. There was a different structure that came out first on every one of them. I mean, basically, there is no one structure that's best for everybody. Each structure has to be tailored for the client that you're talking to. You've got a small dealer, you've got to talk about him. If you want to form your own reinsurance company and you want to participate in the profits yourself, you've got to think about what you're going to do. If you've got a mega dealer that you have a chance to do business with, you've got to think about what's best for them. There literally is no best structure for everybody. And what I could say is for you to be aware of the various structures out there and also be able to market what you think or what you think would best fit your dealer client or yourself if that matter. And I'd like to think that's the best advice I could give you, but I really want to tell you there is no best structure for everybody. So having said that, I still need to tell you what the structures are and the good and the bad of the various structures. I just went right past the domestic. It's not even, as far as I'm concerned, it's too expensive. It's subject to too much regulatory control. There's too little decisions that you can make on your own. I mean, really, unless there's absolutely extenuating circumstances, a domestic reinsurance company or a domestic captive company is really not something I'd recommend. Now, there are absolutely exceptions to that, but I just wanted to say that the domestic is not the most preferential unless the client absolutely wants it. And then do what the client's always right. So the first structure I've evaluated here is the CFC, or the Controlled Foreign Corporation. And here's the positives, and that's, I mean, y'all can read them as well as I can say them, but it's got the lowest costs, the lowest taxes. You own the company yourself. It's generally accepted by the regulatory authorities, and you have the greatest control of your company. You can do what you want, subject to what I just said earlier about the direct writer having the access to, or having control of the trust account. The negatives is the size limitations, not the CFC size limitation. I'm talking about the premium, the fact you can't go above $1.2 million or soon to be $2.2 million. And then the CFC considerations. I did this. I turned it in. Katie would have to tell me when I turned it in. I met the deadline, but I did this, and I was just trying to do generic things that I thought that people should consider. And I've got CFC considerations. I have acceptance of domicile, I have cost of operation, and I have termination language. Let me go from the bottom up. You're always going to see me talk about termination language. If you're going to do your client or yourself a justice and not an injustice, you have to know what the termination language is. You have to know what you're getting into. Cost of operation, I talked about the reinsurance fees and the ceding fees. You need to know how much you're paying, how much your client's paying. Just know what the costs are. And then the acceptance of domicile. And I'm talking a little apart from the theme now. I guess there's a lot of notoriety or a lot of conversation right now revolving around the Turks and Caicos Islands. And that's because they've got a new Financial Services Commission director, and he has proposed some new regulatory rules. And basically, it's kind of onerous as far as what they're asking for. But the thing that I would say is the Turks and Caicos, the Financial Services Commission, a lot of its revenues revolve around the RIC or the pork industry. And I see a lot of hopefully pullback as far as what's been proposed. But right now, there are some fairly onerous proposals being made in the Turks and Caicos Islands. But the Turks and Caicos Islands has been around since I first started doing this business, and it's had a couple of attacks over the years as far as whether it's the place to be. And as far as I'm concerned, it's still going strong. Now, it sounds like I'm lobbying for the Turks and Caicos Islands. The only thing I'm saying is that's probably the most used domicile in here, except for the programs that I'm going to be talking about in a minute. So I'm really talking about CFCs as far as this is concerned. And if the rules do change, I've already got some strategies that might be able to make us some more money, and us being you and me, as far as that's concerned. So if there's one thing I'd like to think that you can be in the regulatory environment we're in, is that you can be adaptive. And with reinsurance, it allows you the best opportunity to be adaptive. So that's the structures for the CFC, and it's still going strong, and it's generally accepted. Oh, by the way, I have had a dialogue with the new FSC director in the Turks and Caicos Islands, and he told me that I could paraphrase something he said, and that is they acknowledge how important this industry is to their country, and they hope to not have to make any material changes to the way the companies operate over there, and hopefully costly changes either. Even though I'll defend them a little bit, and that's the Panama Papers. They're out there, and things are going to change for everybody as far as that's concerned. The next structure I'm going to talk about is NFCs. And basically, NFC stands for Non-Controlled Foreign Corporation. And that's a true offshore insurance company. And here's the positives, the negatives, and the NFC considerations. There is a code section in the Internal Revenue Codes that says a non-controlled or a foreign company can invest in U.S. securities. Now, that's not saying how the managers, the offshore managers run the company. It's not saying how the direct writers run the company. I'm just talking about from an Internal Revenue Code perspective, it is legitimate to invest your funds in the U.S. Now, there's a little asterisk there. That's in publicly traded securities. If you invest in non-publicly traded securities or closely held investments, they're subject to a branch profits tax, a 30% tax right off the top. So you could be exposed to taxes if you're not investing in publicly traded securities. However, there is an exception to this 30% thing, which I won't go into now, but basically it is not disqualify the company if you invest, if the NCFC that you do business with or you're looking at invest in U.S. securities. It really is the lowest tax, it's not the lowest operating cost, but it usually is a low operating cost because you can share the cost of operation of the company with a lot of other individuals. There's no premium limitations. That's the best thing about an NCFC. It also is generally accepted out there. Now, sometimes you see articles out there and they're attacking NCFCs. Are they really attacking protected cell companies? There is some activity in the IRS on protected cell companies, but it does not apply to this business, or at least not directly. It applies to the casualty insurance business, and they're really not trying to do tax lowering. They're just trying to limit their risk. And that's what's happened. The IRS has kind of caught them by them trying to limit their risk. But as far as the NCFCs that I know of in this industry, I don't see any problem as far as acceptance. The shared ownership is sometimes thought of as a negative, but what you have to do is just make sure that the reinsurance agreement that you enter into and the trust accounts that are set up are not that they're equal as far as the NCFC and the direct writer. NCFC considerations. There has to be sharing of risk for it to qualify as an NCFC. But there's ways to mitigate that sharing of risk. And that's just one thing I'll say a positive and a negative, or a negative and a positive as far as that's concerned. Access to funds. Everybody says you're completely disallowed from having access to funds. That is not true. And basically, there are some mechanisms that are out there that could give you access to funds. The cost of operation, make sure you understand the fees. That's both going in, and I got termination, and that's coming out. That's very important. The next one is the dealer-owned warranty company. And as I said, this is an offshoot of TAM 9601001. And my company has been using this strategy for 19 years. So I would be the most two-faced person in the world to say anything negative about a dealer-owned warranty company. But what I will say about it, and this is both I'm going to say the positive. It has significant potential financial benefits with that structure. But along with that, and this is like that chart I did, whenever there's something really good going on, there's something that could be risky going on. And what it is this is not a permanent reduction in tax. It is a deferral of tax. And when you have a deferral of tax, it reverses itself and you have to pay the tax down the road. I'm not sure what is being recommended as far as ways to avoid the tax down the road as far as this is concerned. I know what we have done and try to limit it, and I'm not going to go into that in this meeting, but there are ways that you could strategize to do it. It's just a fairly aggressive policy, like I said. And if it ever were to be thrown out, I told you that case about the owner of Nyquist. I mean, it's getting very close to a tax strategy, but it's legitimate. And just make sure that you know who the provider is. Make sure you know their method of accounting. I mean, if it's aggressive or conservative or somewhere in the middle of the road, and make sure you know the termination. And when I say termination here, I'm talking about the termination provisions, but also the method and the mechanism for terminating. Because once you get in, how do you get out? And that's the question I would ask. But there are some definite, significant financial benefits to a dealer-owned warranty company. Applications. Here's what a dealer can do. He can do a CFC, he can do a non-CFC, and he can do a dealer-owned warranty company. And basically, it's a reinsurance company profit sharing is what I'm talking about. But products and programs is what I want to talk about now. Every product that you can think of in the F&I department is pretty much an insurance product. And every one of those are reinsurable. And they're reinsurable to the dealer or they're reinsurable to you. And I'd love to see agents truly embrace the reinsurance concept and think of ways for yourselves to make money on reinsurance. I mean, you work your tail off and you make a lot of money and you pay 40% tax on every dollar you make and you pay it right then. Why not do some profit sharing strategy so that you can have profits in the future? I mean, I'm truly an advocate of reinsurance, but I'm an advocate of reinsurance at the dealer level and an advocate of reinsurance at the agent level. And I think that's something that all of you should very seriously think about. As far as products are concerned, I said every product. Nearly every aftermarket product is reinsurable. And right now, the food chain for aftermarket products is the manufacturer, the direct writer, the administrator, the dealer, and the agent. You guys are on the bottom of the food chain, I hate to tell you. And there's no reason why you couldn't elevate yourself a little bit on that food chain. And that's something that I would highly recommend that y'all look into doing in doing business. Loyalty products, I'm going to talk about that in just a minute. Next page. Traditional casualty products. I'm talking about, now this is not being done right now, but my goal in life before I retire, I'd love to be able to reinsure traditional casualty products like dealer casualty products, like open lot coverage, like garage liability. I'd love to be able to see that be reinsured into a dealer's reinsurance company. I think it'd be the easiest sale in the world. And one of these days, I'll think of some way of doing it. I'm not sure how. And then non-traditional casualty products. How many of you have heard the term ERM? Two people right here. They must be marketing it. By the way, I know those two people. Anyway, ERM stands for Enterprise Risk Management. And I'm going to say something negative to begin with, but I'm going to end up saying something positive. What it is, it's a mechanism to transfer risk that's not usually insurance risk or thought of as insurance risk to insurance risk. And you can take advantage of the 831(b)(2 or the small casualty insurance company. The negative I'm going to say is there's a lot of promoters out there that are doing ERM business only, and they're really aggressive in what they're promoting. And I think I've made some references to distribution of risk in there, like the brother-sister. It also happens at the product level. If you've got distribution of risk, you're doing a lot. You've made a lot better argument for eliminating any attack by the IRS. If you don't have any distribution of risk, you put your exposure. And a dealer's reinsurance company is a great way to get that distribution of risk. What you do is you put the regular core products in there, and then you put the ERM products in there, and you got the distribution of risk. And with the premiums going up to 2.2 million now, the premium limit going up to 2.2 million, you've got more room in there. So that's something that I bet you're going to see a lot of marketing on. It is aggressive, and you know that schedule. If I were to do it at the product level, that would be pretty high as far as aggressive is concerned. But it's legal, it's out there, and basically, let's don't say legal. Let's just say it's accepted so far. And basically, as long as they don't push the umbrella too much, I think that's something that you might want to consider. And it's a ways for y'all to make some more money with your dealer clients. I mentioned loyalty programs. I've been an advocate for quite a while, but I'm becoming more of an advocate. Basically, you've got a lifetime product of some type. Engine, powertrain, any lifetime product. The dealer can show that as a giveaway. Let's say the premium's $100. That dealer packs $100 more in the policy, does $100 a month or $200 a month. $100 times 200, that's $20,000 a month. That's $240,000 a year that he puts in that, and he's got 100% penetration on that. There's nothing that an insurance company likes better than penetration. If you get 100% penetration, you're literally going to lower the loss ratio a great deal. And that's something that's just almost a non-decision as far as something to consider. And it's something that every one of you should consider as far as your clients are concerned in some type of loyalty program, and look at the products that you can consider putting in there. And on every car, and you establish a premium. It's got to be a practical premium, and every one of those goes into a reinsurance company. Now I'm going to do this right now. I was going to wait and do a teaser at the end, but I'm going to do it right now. What if you're only doing, the 20,000 I said? So that's 240,000 a year. That's really not enough income to justify the formation of a reinsurance company. I mean, the cost is $5,000 to form it, and $3,600 to $5,000. Thank you. To keep it going, and $200,000, you're eating up a lot of the profits on that. Here's a suggestion. Why not structure an NCFC, or maybe even a CFC that has quantifiable premium limits, and you have a very low cost structure. You can share that cost among several dealers and or agents, and therefore you could lower the company cost, but you could get that $200,000 into a deal. And then let me say this, I'm speaking from a personal perspective. We don't like to reinsure business into companies that we don't manage or that we don't know who the manager is. And a lot of other carriers, they don't want to take outside risk into their companies. So that's pretty much a truism throughout the industry. This is a case where if you had a program that you could reinsure this loyalty business into a separate position that's not in the core position that the dealer has, it's a way to get your foot in the door with a dealer that you don't have right now, and maybe you can leverage off of that and you go get all his business. It's just something to think about as far as loyalty programs. So I really think there's three prongs to go after to recommend the loyalty programs to a dealer. And for agents, and this is my second to last slide, literally the sky's the limit. From an insurance company standpoint, a CFC is not the most preferential program to recommend to agents. The reason is there's not enough. You've got 5 agents, 4 agents do good and 1 agent does bad, and all of a sudden you eat all the losses. The carrier eats all the losses for the agent that does bad, and basically the four other agents don't contribute at all. So that's a consideration. But what if you could have a program where the business, every dollar of business had paid a small excessive loss fee, if you will, so that all the agents could participate to provide the excess loss should some agent go under. And basically it could be a fee that's manageable, and it would allow an agent to participate in the profits of the business he produces. I really think there's a lot of opportunity for agents to make a lot of money with the business that you're writing. And I'm just going to say that there's no reason an agent should not be able to participate in the reinsurance in any form that he feels comfortable doing. And my last slide, have you ever had an opportunity to go talk to a public dealer group? And if you have, there's no public dealer group today that has a reinsurance program. And there's several reasons, but the real reason, you can make yourself act like you really know what you're talking about if you say FASB Technical Bulletin 90-1. Now the significance is the 90. It was issued in 1990. And what it says is that if you do GAAP accounting and you have a reinsurance company on the back end, you have the ability to manipulate those premiums. So therefore you have to recognize your dealer commission on the front end over the life of the policy. So if you sell a policy for $1,500 and $1,000's the insurance and $500 is the dealer commission, you can't take the dealer commission in income. You have to amortize it over the life of the policy. But the significance of the 1990 is that was issued when everything was dealer obligor. Most business now is admin obligor. And me and some of my colleagues, I'll call them colleagues, but I don't think they'd call me colleagues. They're lawyers. But they think that there's a way to amend 90-1 so that the AO business is not subject to this deferral of income. Financial institutions. A lot of financial institutions go way over the 2.2 million. But they also, on the other hand, they're conservative. There's nothing to prevent a financial institution from going into an NCFC. They could do it just as well as anybody else. That's something for you to think about. Low volume business, I just told you about a way to create a series of stock that's less costly so that you could put small, let's say $200,000 a year, into a less costly position. You still get the profits, or your dealer client gets the profits, but the cost factor is affordable. GAAP, aftermarket, that is an issue with dealer-owned warranty companies, but there's nothing to prevent you from forming another company for the dealer if the benefits, he thinks the benefits truly outweigh the additional cost of another insurance structure. Of course, you've got the $1.2 million consideration, so you probably need to think about an NCFC at that time. And then pre-maintenance as a standalone product, that's problematical. But if you package it with a service contract, there's ways of making that a reinsurable product. So I've gone as fast as I could and tried to give y'all a sense of reinsurance. There is some benefits to reinsurance, try to pique your curiosity as far as what might be available out there. And now I want to try to give away a trip.